Hi, everybody, and welcome back to video number 5 in Chapter 9. When we left off, we were looking at issuing stock, and here we have an illustration of Upgrade Living Company. They decide to purchase some adjacent land for expansion of its carpeting and cabinet operations. So instead of paying cash for the land, the company issues 5,000 shares of common stock with a par value of $10 per share to Deed Land Company that have a fair value of $12 per share. What entry are they going to make to record this transaction? Fairly easy one here. Land, we're going to debit for 60,000. That's 5,000 shares times its fair value of $12 per share. Common stock will credit for 50,000, 5,000 shares times its par value of $10 per share, and the difference being paid in capital in excess of par dash common stock. Okay. Exchanges of non-monetary assets. Ordinarily, we're going to account for those on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. Companies should recognize immediately any gains or losses on the exchange when the transaction has commercial substance. All right. Here's an illustration. Andrew Company exchanges some of its equipment for land held by Roddick Incorporated. It is likely that the timing and amount of the cash flows arising from the land will differ significantly from the cash flows arising from the equipment. Does this transaction have commercial substance? And if so, how would you record this transaction? Both Andrew Company and Riddick Incorporated are in different economic positions after the exchange. Therefore, the exchange has commercial substance. The companies would record their acquired asset at fair value and recognize a gain or loss on the exchange. Here, an exchange has commercial substance. You'll see that terminology used extensively in accounting literature. And it has that commercial substance if future cash flows change as a result of the transaction. That is, if the two parties' economic positions change, the transaction has commercial substance. So, here, the type of exchange has commercial substance. What do? We're going to recognize gains and losses immediately. If it lacks commercial substance and no cash is received, then we're going to defer any gains and recognize losses immediately. If the exchange lacks commercial substance and cash is received, then we'll recognize partial gains and recognize losses immediately. If cash, if you see in this last, has an asterisk here, if cash is 25% or more of the fair value of the exchange, you're going to recognize the entire gain because the earnings process is complete. Okay. Now, if we look at a loss situation, companies are going to recognize losses immediately, whether or not the exchange has commercial substance. The rationale is that the companies should not value assets at more than their cash equivalent price. If the loss were deferred, assets would be overstated. Let's take a look at an example, this time with Caribou Coffee. And it trades its used espresso machine for a new model at Gourmet Coffee Solutions Incorporated. The exchange has commercial substance. The used espresso machine has a book value of $8,000. It originally cost $12,000 and it has accumulated depreciation of $4,000 and a fair value of $6,000. The new model lists for $16,000. Gourmet Coffee Solutions gives Caribou a trade-in allowance of $9,000. At what amount would you record the cost of the new espresso machine? What journal entry would Caribou Coffee make to record this transaction? Okay, the cost of the new espresso machine is $13,000. And we derive that. Here's the list price, $16,000. Trade-in allowance, $9,000. Cash payment, $7,000. The fair value of the used machine is $6,000. So the cost of that new machine is $13,000. We gave up the fair value of that used machine, right? We traded it. Caribou then is going to record this transaction. The new equipment's going to get $13,000. The old equipment is going to go away. Accumulated depreciation on the equipment is $4,000. And the loss on the cash is going to be $7,000 here. So that means we would have a loss on the disposal of equipment of $2,000. And we can verify that loss relatively easily by taking the fair value of the used machine less the book value of the used machine, and that gives us the $2,000 loss on the disposal of the used machine. Okay, now we could also have a gain, and that has commercial substance. The company usually records the cost of a non-monetary asset acquired in exchange for another non-monetary asset at the fair value of the asset given up and immediately recognizes a gain. Let's take a look at that. Interstate Transportation Company exchanged a number of used trucks plus cash for a semi-truck. The used trucks have a combined book value of $42,000, and that cost us $64,000, but there's $22,000 of accumulated depreciation. Interstate's purchasing agent experienced a secondhand market, and that indicated that the used trucks have a fair value of $49,000. In addition to the trucks, Interstate must pay $11,000 cash for the semi-truck. This exchange is considered to have commercial substance. At what amount would you record the cost of the semi-truck? And what entry should Interstate make to record this transaction? Okay. Here, the fair value of the used truck exchanged was $49,000. That was given in the problem here. And we had to pay an additional $11,000 in cash. So the total cost of the semi-truck was $60,000. After the exchange, Interstate is in a different economic position. Therefore, it had commercial substance. Interstate recognizes a gain and records the exchange transaction as follows. Here, they're bringing on the new machine, a new truck, at $60,000. We're getting rid of the old truck, so we would debit accumulated depreciation and credit the asset to zero that out. We're paying this $11,000 here in cash. Therefore, we need $7,000 to balance this out, and that's going to be a gain on the disposal of the trucks. We can reconcile that or verify our computation by the following calculation. Here's the fair value of the used truck, $49,000. Here's what we gave up, the book value of the used trucks, and that difference is $7,000. Okay, the basis of the semi-truck at fair value versus book value. Here, the fair value of the semi-truck is $60,000. The book value of the used trucks, $42,000. We have a gain. We defer the little beauty. Here, that takes us the basis of the semi-truck is $53,000. Here, we add the cash paid on top of the book value of the used truck, and we get the same $53,000. Okay. Now, if it lacks commercial substance, we're going to go through these same calculations here. But let's go back. Okay. So Interstate then is going to record the transactions as follows. Same set of numbers. Now, when a company receives cash, sometimes referred to as boot, in an exchange that lacks commercial substance, it may immediately recognize a portion of the gain. The general formula for the gain recognition is when an exchange includes some cash as follows. Here's the cash received, the boot as it's called, divided by the cash received plus the fair value of the other assets received. And that's going to give us, we're going to multiply that times the total gain, and that will give us what we're going to recognize as the gain. I hope that was clear. All right, here, this exchange lacks commercial substance, but some cash is received. Let's assume the Publix Corporation traded in a blue used delivery vehicle with a book value of $60,000 and a fair value of $100,000. It receives in exchange a green delivery truck with a fair value of $90,000 plus $10,000 in cash. This exchange lacks commercial substance. So, alpha, what is the total gain, if any, on this exchange? Bravo, what is the amount of gain, if any, will be recorded on this exchange? And Charlie, what entry would Publix make to record this exchange? All right, so the total gain, we're giving up a $100,000 machine, less the book value of the machine that we gave up. So we have a pretty good sized $40,000 gain. So generally, when a transaction lacks commercial substance, the company is going to defer any gain. But because Publix received $10,000 in cash, it's going to recognize a partial gain. The portion of the gain a company recognizes the ratio of the monetary assets, cash in this case, to the total consideration received. So here's our $10,000 cash and the total consideration $100,000 and our gain of $40,000. So we're going to recognize a $4,000 gain. Publix recognizes only a gain of $4,000, and it's going to defer the remaining $36,000, the difference between $40,000 and $4,000, and reduces the basis recorded cost of the new machine as shown in the following summary. So here it is. Here's that $6,000 that we just calculated. Okay, that's the same calculation we did previously. That looks like a good place to stop this video, and when we return, we will take a look at the remaining part of this exchange. Until that time, bye for now.